Hello, clients of Morrissey Wealth Management, other listeners of the Retire with Ryan podcast. I want to just give you a brief market update on what's been going on. Today's Monday, April 7th. I'm sure you're aware that the prior 2 days for the stock market have been significant as far as significant decline, 2 days of back-to-back 5% decline. And we haven't seen anything like that since COVID, since shortly after COVID and the volatility. It's possible that today, Monday, April 7th, can be another down day in the market. But before you panic and before you make the wrong decision, I just want to give you some perspective and some things to consider, as we're going through this volatility. So let me share my screen. So as far as volatility, this is definitely nothing new in the markets. It has definitely been a while since we've seen this extreme volatility, but volatility unfortunately always exists anytime you're investing in stocks. And if we look at the last 30 years, a little over 30 years, since 1990, I found this chart from MFS. There's been a number of times where the S&P 500, that's the 500 largest stocks, have had an inter-year decline. That means at some point during the year, there's been a decline in excess of 17%. So we have here, that's what these little gray dots are. These are the number, this is the total bottoming inter-year of the S&P 500. So we can see it happens many years. Very few years does it start off that the S&P 500 goes up and stays up. So if we look at just the declines where it's been more than 10%, so I'll count them here. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. 18 times in the last 35 years, the S&P 500 has declined more than 10% inter-year. And of those declines, only 9 have led to a down year. So it's very possible that this year could turn around. Now, obviously, it's gotten off to a very bad start where, as I'm recording this, before the market opened, we're down 17% on the S&P 500. So not officially in bear market territory. A bear market is declined by a 20% decline or more. It's possible that at the end of today, we are in bear market territory. So does that mean that you should give up on your investments on your portfolio? Probably not. All clients of Morrissey Wealth Management have an asset allocation. For our clients that are younger, that have most of their money in stocks, if you do, that's because you have a long time frame until you're going to need that money. So you're probably not needing that money for 15 or 20 years or more. So people like that, any investor, you probably should sit tight with the stocks that you own, because if this year is anything like past years, the markets will recover. It possibly even could recover within this year. For people that are closer to retiring or actual retirees, you don't have all of your money invested in stocks with Morrissey Wealth Management. If you do as a retiree, then you probably want to reconsider your asset allocation. So our clients that are retired have anywhere from 30 to 50%, some even 60% of their portfolio invested in cash and bonds. And cash and bonds are doing their thing. Cash and bonds are actually up on the year, so they are holding their own. However, stocks are down such a significant amount that you're still seeing negative declines on your portfolio. Anywhere from 8 to 10% is what's happening, even with a diversified portfolio at this point. But it's better than 17% or 20%, depending on what areas of the stock market you're invested in. So why do you own stocks? Because stocks over the long term are where you're going to allow your portfolio to grow. And if you're someone who's retired, you're going to allow your portfolio to replenish the withdrawals that you're taking to sustain your retirement income and also to keep pace with inflation. So this is another chart that MFS has, and they look at rolling periods going back over the last 30 years. And we find here that of rolling periods, this is back to 1949. If you have a 5-year holding period, rolling period, stocks are positive 84% of the time. If you have a 10-year rolling period, stocks are positive 92% of the time. So that means that if you're a long-term investor, which probably most of you are, most of my clients are, you're investing for the long term. Even if you're someone who's retired, you're not going to need all of your money right away, so that you really have a long-term investment horizon, 15, 20, 30 years, depending on how long your retirement lasts. So that being said, if you hold your stocks, you don't do anything, then there's not going to be any losses that you're going to sustain in the long term. There's definitely losses you're seeing now, but those losses are only realized if you actually sell out of your stocks. Now, it's possible with this, what's going on here, this is self-inflicted in the sense that most other bear markets are due to existential things that happen, like the financial crisis, like COVID. This is being done because of Trump's decision to institute tariffs. And it's possible that this is a negotiating tactic. I know he said it's not, but it possibly is. There's a high probability that it is. And if the tariffs are resolved, the stock market could really come back rather quickly, and kind of similar to how it did over COVID. Now, that being said, one of the reasons why you don't want to get out of the market is because you don't want to miss the best days. This comes from JP Morgan, and it shows over a 20-year period from beginning of 2000 to the end of 2019 what the S&P 500 returned, and it returned less than what you would have thought. It only had an average return of 6% per year. Obviously, some years were better, some years were worse, but that was your average return if you started on day one of 2000 and you ended on the last day of the year in 2019. But if you missed just the 10 best days of the market, your return was cut in half, not your average return per year. So we can see here that if you invested $10,000, it would have grown to $32,000 at the end of 2019. But if you had done the same $10,000 investment and you missed just the 10 best days of the market, you had less than half of the money. Now, what if you missed the 20 best days? Well, you barely even made any money. You made $167 for your troubles over 20 years. Now, why am I pointing this out? Because most often, the best days come after the worst days. So that if you're getting out of the markets now, you're thinking, okay, I don't want to see any more of this volatility. And you're not alone, because everyone who's an investor has a pit in their stomach. But if you can hang in there and not do anything, the markets will eventually find a bottom and they'll come back. But if you miss some of those best days, that's where you're going to significantly reduce your return and most likely cause long-term damage to your portfolio. It's possible that maybe you could get out and maybe things go lower from here. It's anybody's guess. This volatility has caught many of us by surprise. This is certainly something that I haven't seen in a long time, but it doesn't mean that it's different. It doesn't mean that it's time to give up on your investment portfolio. As I said, for clients who are retirees that are clients of Morrissey Wealth Management, we don't have all of your portfolio invested in stocks. We have, as I said, anywhere from 40% up to 60% of your money invested in bonds, depending on your risk tolerance. And that means that if you need money, we're going to take it from your bond portfolio. We're not going to sell stocks right now because we want to leave the stocks alone as much as we can, so that when you need income, we take it from the bonds, and then we will rebalance back to your original allocation when the opportunity presents itself. So why am I showing you this chart? Because I put this together a few years ago, looking at the maximum drawdown of the S&P 500, and this was during COVID. So over 08-09, which is the most recent, biggest decline since I've been a financial advisor, I started in 2001. We will see here that during that time frame, the S&P 500 declined 44%. Okay, and if you didn't do anything, it took a while. It took 1,400 days for it to recover. But the more money you have in bonds, let's just say you have 60% in stocks, 40% in bonds, you still saw a 25% decline. But it only took you 650 days to recover. So almost 2 years it took you to recover. But if you didn't sell and you did nothing, you're still averaging 8.44% return over that 14-year period. Now, I have no idea how long this recovery is going to take, but eventually the market will find a bottom. Things will settle out. Either will adjust to the new norm that will be higher tariffs, and the market will definitely reprice itself, or possibly the tariffs, some of them will be walked back, renegotiated, and the markets will go higher. Doesn't mean it's easy to go through. This is certainly scary times for everybody. But again, if you have an asset allocation, I would say stick to it. There could be a rebalancing opportunity if stocks do go lower to rebalance back to your original allocation. And things that you can do, if you can turn off the news, it's probably very helpful, good for your health, good for your stress level. Maybe try not to look at your statements as much. It's not meaning that you shouldn't be aware of what's going on, but if you have an asset allocation, you're sticking to it, there's really not much that you're going to be able to do. And definitely focus on your health. Get out there, do some exercise, do some walking. That's always going to be good for your long-term, wealth and health as far as staying healthy and staying active. Don't just sit there and be glued to the TV of what's going on. The financial, pornography companies, as I like to refer to them, are happy that you're watching CNBC, Fox Business, but it's really not helpful for your long-term success. So if you have questions about your portfolio, definitely we're here to help and talk you off the ledge, so to speak, because we don't want you to be selling at this point, because you're really just going to be hurting yourself and your long-term success. Hopefully this video adds some perspective. And again, if you have questions, reach out to us, and we'll be seeing many of you for our annual reviews and reaching out with more updates as necessary. Take care.